What are mutual funds? Mutual funds pool money from various investors to invest in a diversified portfolio of assets such as stocks, bonds, and other asset classes as per their strategy and type of scheme mentioned in the scheme information document. Managed by professional fund managers, these funds offer a way to invest in a broad range of assets without you having to pick individual securities yourself. This diversification helps spread risk and can lead to more potential returns over time. Types of mutual fund scheme. Mutual funds are generally classified into three main categories: equity, debt, and hybrid funds. Equity mutual fund. These funds mainly allocate their investments in stocks, providing the opportunity for substantial returns over an extended period. There are 11 distinct types of equity funds, each designed to meet various investment strategies. Large-cap mutual funds focus on the top 100 companies based on market capitalization, while mid-cap mutual funds concentrate on companies ranked from 101 to 250, and small-cap mutual funds target those beyond the 250th position. Additionally, there are flexicap funds, which invest a minimum of 65% of their total assets in equities and related instruments, offering a diversified investment approach across different market capitalizations. Other categories include index funds, sectoral thematic funds, and tax-saving mutual funds such as equity-linked savings schemes, ELSS, which provide tax benefits under Section 80C of the Income Tax Act. These varied options grant investors the flexibility to select funds that best suit their financial objectives and risk appetite. Debt mutual fund. They are suitable for conservative investors who wish to focus on generating regular income. These funds generally allocate their investments in bonds, including government securities and corporate bonds, which yield lower returns than equity funds but come with diminished risk levels. Examples of debt funds encompass overnight funds, liquid funds, dynamic bond funds, long-term income funds, etc., which serve as relatively practical investment choices for individuals in pursuit of consistent returns. Hybrid funds. These funds allocate investments across both equities and fixed income securities, providing a balanced strategy regarding risk and return. Hybrid funds strive to deliver growth through the equity component while ensuring stability through the debt component, making them appropriate for investors with a moderate risk appetite. For instance, conservative hybrid funds, balanced advantage funds, aggressive hybrid funds, etc. Step-by-step guide to selecting an investable mutual fund scheme. Define your financial objectives. Clearly articulate your investment aspirations, such as saving for retirement, funding your child's education, or planning for marriage. This clarity will aid in selecting the appropriate asset class mix and, consequently, the suitable mutual fund schemes. Furthermore, utilizing a mutual fund SIP calculator can help in estimating potential returns and enhancing your investment planning. Evaluate your risk tolerance. It is crucial to comprehend your comfort level regarding market volatility. Equity funds carry a higher risk with the potential for greater returns, whereas debt funds provide more stable returns. Take your investment horizon into account. The choice of asset class is also influenced by the duration of your investment. Equity funds are generally more suitable for long-term investments, 5 years or more, while investors may opt for debt funds for short-term investment strategies. Assess fund performance. While the historical performance of a fund does not assure its future returns, it provides investors with a degree of confidence. To mitigate recency bias, one should examine various timeframes of returns, such as calendar year returns and rolling returns. Potential returns across diverse market conditions are encouraging, even though they do not guarantee future success. Evaluate fund costs. It is crucial to consider the expense ratio linked to the mutual fund. Reduced costs can have a significant effect on your overall returns, so it is advisable to choose funds with competitive fees. Typically, passive funds incur lower investment costs. Consulting a financial advisor before making an investment is recommended. Assess fund manager competence. A fund manager is a professional responsible for managing your investments by allocating the fund's capital, and thus, an experienced and skilled manager can enhance the fund's performance. Diversify your portfolio. Investing in various categories of mutual funds across different sectors aids in spreading risk among various assets. A diversified portfolio can help mitigate market volatility affecting your investments. Comprehend tax implications. For equity mutual funds, long-term capital gains, LTCG, are taxed at 12.5% if held for over 1 year and exceed Rs. 25 lakh annually. Short-term capital gains, STCG, are taxed at 20% if held for less than a year. In contrast, the tax on debt mutual funds is applied at the marginal tax rate, regardless of the investment duration.